Hello, my name is Brenton Harrison with Ultra Borrowers Academy, an online course where we help people with a mountain of student debt put themselves back on a better chance, on a better path to a financial portfolio worth having and not letting their student loans be the thing that dictates their financial future. We hope that these videos have been helpful to you so far. And what we wanted to do today is we wanted to do a video about Parent Plus loans. This is a really damaging type of loan that you've seen a lot of parents take out on behalf of their children when it comes to their schooling. We wanted to go through some quick options for how that debt can be repaid and specifically how it can be handled in the event that you choose to refinance that debt. So let's get into it. First, what is a Parent Plus loan? As we said, a Parent Plus loan is a loan that's available to the parents of dependent undergraduate students. If you're wondering why this is even needed, when it comes to undergraduate studies, in many cases, you are very limited as to how much debt you can take out. So if you're at a private school where you have high room and board costs, high tuition, a number of different fees that you have to pay, a Parent Plus loan is an option for a family who may be maxed out in terms of what the student can take out in their name, where the parents can then go and get a Parent Plus name in the name of the parents. In order to be eligible for a Parent Plus loan, you must be the parent of a student who's studying at least half time at an eligible institution, and these loans are offered at a fixed interest rate. These are the overarching details of Parent Plus loans. Now, Parent Plus loans can be really damaging, both because it's putting debt that you aren't really benefiting from in your name, but also because many people take out tens of thousands, if not six figures worth of loans on behalf of their children. Now, when it comes to repaying that debt, you could pay what's called a standard repayment plan. We've covered that in previous videos. A standard repayment plan is where whatever your amount you pay each month is designed to pay that loan off in full within the given period of time. However, for a couple of reasons, one being that the interest rate on Parent Plus loans is pretty high, the other being that many take out so much in Parent Plus loans that it's hard for them to pay it back on a standard plan, many choose to instead use what's called an income-driven plan. We've covered income-driven plans in the past, so we're not going to go into it in detail in this video, but suffice it to say, a income-driven plan is a plan where the payment that you make has no connection to your loan balance. It's instead, based on the plan you choose, calculated as a payment of 10, 15, or 20% of your discretionary income, which is a formula that we've done in the past. The other part of these plans is you may not pay your loans off in full within the given period of time while using an income-driven plan. If you do not, any remaining balances that you have on that loan will be forgiven after either 20 or 25 years of payments, again, depending on the plan that you choose as you repay this plan. This is relevant to Parent Plus loans because unfortunately, while we've covered income-based repayment, while we've covered pay-as-you-earn, while we've covered revised pay-as-you-earn, and these plans have payments that range from 10% to revised pay-as-you-earn, 10% with pay-as-you-earn, either 10% or 15% for income-based repayment, and the range in terms of the payment period can be 20 years or 25 years on the high end. Unfortunately, when you have a Parent Plus loan, the only payment plan that you can use that's an income-driven plan is the income contingent repayment period. Now, income contingent repayment is the worst of all the plans when it comes to income-driven repayment. First, because it has the highest payment period. It has a 20% discretionary income payment as opposed to 10 and 15% with the lower plans. And there are some differences in terms of how they calculate that discretionary income when it comes to income contingent repayment. But suffice it to say, it has the highest repayment of all the plans. And it also ties for the longest repayment period. Under income contingent repayment, you have to pay your loans for 25 years before you've either paid it off before then or any remaining balances are forgiven, and you have to pay income taxes as if you earned any amount of loans that was forgiven in the year of forgiveness. As I said, this is the only plan eligible for Parent Plus loan. It has a payment cap. We've talked about that in previous years, but essentially, the best way to explain it is this. If when calculating your income contingent repayment payment, they find that instead of being on the track or on the hook for 15 years or 20 or 25 years, that you're paying so much under this plan that you would actually pay it off in faster than 12 years, they will actually kick you off of the income contingent repayment plan and instead bump you onto the 12-year standard payment. That's what it means when we say it has a standard payment cap. But unfortunately, we've also covered in the past that there are a number of different interest subsidies. And an interest subsidy is where the government covers some of the interest that your payments doesn't cover when you have student loans. Well, unfortunately, under income contingent repayment, there is no interest subsidy, meaning that if you're not paying enough under this plan to meet the interest that's growing on your loan, there is no help from the federal government to help you repay it. So it is an option that is really only ideal if, when you're looking at repayment options, you are also considering applying for public service loan forgiveness. Public service loan forgiveness is a program where if you meet certain requirements for a period of 10 years, one of those requirements being that you work for a public service employer, you can actually have your loans forgiven in full with no taxes after you've made 10 years worth of payments. Well, one of the other requirements of these public service loan forgiveness programs is that you have to be paying back your loans using an income-driven plan. So if you're a parent who works for an eligible public service employer and you want to get the loans for your child that are in your name forgiven as quickly as possible, it may benefit you to aim for public service loan forgiveness. And if you do, unfortunately, the only plan that you can choose is the income contingent repayment plan. Another option, if you don't want to do a standard plan with the federal government, is to refinance those loans with a private lender. Now, we're going to talk about two different options in terms of this refinance, because remember, this loan is technically in the name of the parent. And if you have an old school lender who is really in the position where they haven't really updated their processes as it relates to student loans, then you may not be able to take that loan in the parent's name and refinance it in the name of the child. But it may still benefit you to refinance the loan in the parent's name into a private loan in the parent's name if there is a significantly better interest rate or better terms that are associated with those loans. It could still benefit you to do it in that manner. But there are lenders now that have updated their policies and procedures so that they do offer the ability to take a parent plus loan that's in the name of the parent and refinance it in the name of the child. And if you have a child who's now out of the house, who's on their feet financially, and this loan was for their schooling, it may be something that you either need to do or that they are able and willing to do, so that the burden that they took out for their schooling is now their responsibility, as opposed to something that's only in the name of the parent. There are actually a few workarounds in terms of the payment program that you can choose when it comes to income contingent repayment. But that is something that's a significant loophole. That's a number of steps, which we'll make its own video in the future for. But this is Brenton Harrison again with Ultra Borrowers Academy. We hope this video was helpful. If you've been enjoying what we've been posting, we invite you to subscribe to the page and check the notifications so that you know when new videos are posted. And if you want to take our course and look into more of the details of what we offer, you can go to ultraborrowers.com and we'd be happy to take you from there as well. I'll see you soon.